Whenever those investments make money, it flows back to the pool and then gets split between us and our investors. So that's kind of all I mean when I'm saying funds. This could be syndications. You could have a full private placement fund. So the world of like private equity hedge funds, like what's the difference? They're actually all structured almost exactly the same, which is kind of crazy.
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome everybody to today's Capital Raising Show. I'm your host, Tim Mai, and today I have an amazing guest, super young, but very successful. He's huge in the fund management world. And his name is Richard Pennington. He's the CEO and co-founder of Fund Launch, formerly known as Investment Fund Secrets, which has helped over 20,000 students to start their own funds, myself included. Joined Richard's group April of last year, 2022. So I've gotten to get into his world quite a bit. Richard is the founder and manager of 3 funds, which he started his first fund when he was in his 20s. I think 22 it was, right, Richard? Yeah. And so Richard has experience in all different type of funds, including crypto funds. He's currently a general partner on the Ugly Unicorn Fund with more than $10 million AUM, and also a real estate fund. Prior to starting and launching Fund Launch, he started a number of small businesses, many of which he started doing school at Brigham Young University, where he studied finance and financial management services. And between 2014 2016, Richard served an LDS mission to Taiwan, where he became fluent in Chinese. That's cool. My wife is Chinese. I'm Vietnamese, but that's really awesome.
Really cool.
Yeah, let's everybody. Let's give Richard a Zoom welcome.
Well, thanks for the intro. I don't even know where you got the intro from, but that was sweet. I think actually now I'm a partner now on 6 different funds now, which is kind of cool.
Oh wow! Okay.
Including the Ugly Unicorn. So yeah, we partner now on a bunch of funds, and it's been really cool. So excited to be on though. I'm excited to hang out with you guys. We got a punt. I see Jordan on here, a bunch of cool people on here, so I'm excited to hang out.
Yeah, we definitely have a lot of cool people. Yeah, so share with us a little bit about your how did you get started in the fund business to begin with at such a young age?
Do you want the short version or the kind of longer version?
Whichever version. Yes. Whichever version you want to give us.
All right. Well, I'll just go quick. I'm sure some of you guys have heard my story before, but like Tim said, thanks so much for having me, you guys. It's fun to be here. We run Fund Launch right now. We've got, I think, 40,000 students around the world between all of our stuff. And our goal was just to help more people learn how funds work, how they're put together, how they're operated. We've then done courses. We have live events. We have all sorts of cool stuff. I see Shafin's picture there. It's actually him at our event. I think with me on stage, just him though. It's pretty cool, which is pretty fun. So I'll take you back a little bit. I like you said in the intro, I won't go too long, but I went on a mission, got home, was super ambitious in college, probably like a lot of you guys. I got into college. I was like, my hair was lit on fire. I was like, I got to make money. And the best way to make money is through business. And so I started 6 different businesses my first 2 years of college. I started a Chinese tutoring company. I started a website building company. I did Forex trading. I wholesaled 2 houses. Anybody wholesalers? I wholesaled 2 houses. Anyways, any freaking business that I could find on YouTube, I tried. And finally, my dad grabs me and he's like, Bridger, you're kind of like a chicken with your head cut off. I want you to go meet with my business partner. I think this guy can really help you out. I said, I'll go meet with this guy. And so I go out and my dad, by the way, I grew up in a very normal household. I grew up in a household, my dad, it was fine, nothing bad. My dad drove a 300,000 mile car on it, dent in the door, like old beat up car, house, kind of whatever. And I went up to meet with my dad's business partner. I drove this guy's house, beautiful, white, gorgeous house. I come in, he's got the pool, the cars, the whole cool thing. And I come and I'll kind of tell the story quick, but I sit down, and he starts to teach me about the world of funds. I kind of asked him, how'd you get all of this? How'd you do this? And he says, we've ran a number of investment funds, primarily real estate funds. At the time, they were managing over $8 billion of real estate, which was just crazy. Wow. Holy crap, this is wild. And to put that into perspective, that's 4 times bigger than Cardone Capital is today. And now today, those funds, and my dad's since retired, but they're now over $40 billion. So that's 10 times bigger than Cardone Capital. Wow. It's like 10x, baby. Let's go. Right? I love Grant Cardone, but yeah, it's pretty crazy. And so I was meeting with this guy. I was like, holy crap, like, can I learn more? I want to learn from you. Can you mentor me or coach me? He said, Bridger, go talk to your dad. He goes, your dad knows way more about this than I do. I said, no, my dad's kind of poor. You're obviously super rich. Like, I want to learn from you, dude. And he said, Bridger, sorry to break it to you, but me and your dad make about the same amount of money. And my chin dropped to the floor. I was like, huh? Like, come again? He's like, yeah, me and your dad are pretty much equal business partners on this. And I left the dude's house. I drove straight to my dad's house. And I was like, Dad, what the heck? Like, what's going on? Like, why are we living in this smaller house? You don't drive a nice car. Like, what's going on? Like, why haven't I been able to order like dessert at like dinner for the last 10 years? Because it's too expensive. And yet you're managing a $10 billion fund, right? And anyways, long story short, my dad started teaching me about funds, and he started. So every Sunday night, I drive to my dad's house. We get the whiteboard out, and he teach me about funds, how they're put together, how they work, how the back end works, the whole 9 yards. And it's funny, like a lot of you, we when you start to learn something, you start to recognize that thing in your life. And so I started to go out and recognize opportunities to start a fund in my world. And to kind of give you just an overview of funds really quick, like when I say the word fund, all I mean, so kind of what my dad taught me is like all a fund means. So we're talking private equity, hedge funds, venture capital, real estate funds. Crazy enough, they all actually run kind of the same. We helped launch 120 funds last year out of our group in all of those different categories. We actually do the legal. We help like people that run BlackRock. We actually come in and help you launch your fund. And so when I mentioned fund, all I mean by a fund is a pool of money. Investors pull money to that pool. People like me and you draw from that pool of money. We go and make investments. Whenever those investments make money, it flows back to the pool and then gets split between us and our investors. So that's kind of all I mean when I'm saying funds. This could be syndications. You could have a full private placement fund. So the world of like private equity, hedge funds, like what's the difference? They're actually all structured almost exactly the same, which is kind of crazy. And so my dad started teaching me this. Like, for example, a private equity fund, all that means is they're a pool of money, just like I said before. And all that changes the assets they purchase. That's the difference between private equity, hedge funds, real estate funds. It's just the assets they buy. So a private equity fund buys private equity or private ownership in companies. So for example, Sycamore Partners on Wall Street, probably a lot of people on this call probably have never heard of them, Sycamore Partners. However, they own Nine West Shoes, Aeropostale. They were trying to buy Kohl's department store this year. Last year, they were trying to buy Victoria's Secret. Okay, that's a private equity firm. We actually help people do small private equity. So we have people that they have a business and they go buy up their competitors, or they have a restaurant and they want to buy up 5 new locations. We'll help people do that. Hedge funds, pool of money. Instead of buying private companies, they buy public companies. They buy stocks, bonds, options, Forex, all that kind of stuff. Real estate funds. It's in the name, right? You have a pool of money, you go buy real estate. So anyways, my dad taught me this kind of stuff. And I took this, and sorry, I'm going too long here, but I cut me off whenever you want. But I took this and I was like, so I was in college, I'm working a job and trying to start businesses at the time. And at this one job, I had an idea where we could start a fund at this company and finance the clients that were coming through this company. They needed financing these short-term loans. So I thought it was a cool idea. I took the idea to the owners of the business. I said, hey, what do you guys think? Should we start a fund and do this? And they're like, this sounds awesome. I took it to my dad. We kind of structured this whole fund. It took me about a month or two to structure it all together. And then I kind of hit this wall. I was like, shoot, I've got to raise money. Like, crap, like, what am I going to do? And so then I thought, aha, easy. Like, I'll go pitch my dad. Like, obviously my dad will invest, right? He's apparently super rich, doesn't invest his money, doesn't spend it. He'd probably love to invest in my thing. So I remember it was like a late Sunday night, sat down with my dad, and I said, Dad, how would you like to be our first investor into our fund? And my dad kind of laughed and smiled and said, Bridger, if I invest in your fund, I would ruin the experience of you raising money on your own. And he said, this is a crutch that you'll never be able to recover from. And he said, no, I'm not going to give you any money. And he kicked me out. I walked out kind of with my tail between my legs a little bit. And I said, screw it, I'm going to go do this. And I went out, I talked to everybody I knew. And I talked to former bosses, college professors. You guys have done this before, right? You talked to everybody. And I raised a whopping $49,500 from like 7 different investors. And which was good for me. That's pretty small, but if you guys know anything about capital, right, that's like teeny, right? But it was enough to get started. It was so awesome. And so we launched this little fund. We were doing these small micro loans. They were like 30 to 60 days. Just so cool. And our first group of investors got a 64% return on their money, which was good return. Good. So good return, low amount of money. we closed that first little syndicate fund. We then launched an official fund. We raised and deployed millions of dollars out of that second fund. I ran that for about 3.5, 4 years. So about a year and a half ago, 2 years ago, we had a competitor come and actually buy us. We had an exit. We exited our fund. We sold the entire fund, which was awesome. Got a nice check. Wow. And then, during that time period, a lot of people started to ask myself, my dad, and my brother is also a securities attorney on funds. So he actually works at the largest law firm in the world for funds, helps put funds together. So between the three of us, we started to teach people and educate people on funds, how they're put together, how they're structured. And then since then, I launched a unicorn fund. We raised 10 million on our launch there, which is really awesome. It's done actually very well in the last year. We've had a crypto crash and we've just killed it. It's been so cool. And now I'm a partner on 6 funds. We have 8 student funds. So in Fund Launch, we have all these students that come in. Tim, you're one of them. A couple other people that come in. They're amazing, these funds. We have one group, they're $8 billion. We have 4 student funds over 100 million and 54 funds between $1 and $50 million in our group, which is so cool. It's just been a blast. And we throw live events. We have a huge 2,500 person event we're throwing. We do all sorts of fun stuff to help more people launch funds. So anyways, that was kind of the longer story, Tim.
No, that's perfect. That was awesome. So the $49,000 that you raised for your first fund, what were some of the challenges that you went through? You know, number one, I mean, you're young, it's your first fund. Did you raise from anybody that was outside of sort of close relationship? It was maybe they're a close acquaintance, but not really a relationship. So yeah, share with us some of your challenges that you went through with raising money for that first fund.
Yeah, I was young, I was inexperienced, I had no track record, I hadn't graduated from college. That was huge. I was like, who's going to invest in me? And the people I ended up raising from were most of the people that were like closer to me didn't invest. It was more, some of the owners of the business wanted to put money in. I had a few other people. Anyways, I just talked to a ton of people. I think that 49,000 was like, 7 or 8 people, 6, 7, 8 people. So like the average check size was like $8,000, like it wasn't large. Like that's a pretty small investment, but I just told people, like, you just give me a trial investment. I'm going to knock your socks off. I promise. And so I think a couple people are saying, you know what, we'll give this kid a chance. And that's how it went. So I can talk more to that too, but that's kind of the route I went.
Gotcha. Yeah, that's good. So a lot of people on the call, my audience, they're syndicators, real estate syndicators. So they're used to raising money per deal. And in our industry, there's because our investors are so trained on investing in syndications, there's a resistance toward the fund model. Can you share with us, what have you found as a way to explain a fund model, maybe that can better help transition someone who's used to investing into syndication over to investing in the fund?
Yeah, I'll kind of give 2 examples. This will be, I'll kind of, for people that aren't even aware about how funds will help you. So, and then we'll talk about how to pitch that to investors. So we had a guy in our group actually join. He was a house flipper. So I'm sure any house flippers in the group, people flip houses, type like yes in the chat or something, just so you can get a count. Okay. A few people raising hands. Cool. Okay. I'm going to summarize your whole job in like 30 seconds. Okay. Let me know how I do. So don't be mad at me, but this guy in our group, he joined, he was flipping 4 houses a year. He went from 4 houses to 72 houses in 1 year. And because we set up a fund. So anyways, I'll summarize kind of, and let me know if I did a good job, but a lot of you guys will find a house. You then you use bank money, hard money, investor money, or your own money. You pool that money together into like an LLC. You're calling up people, you're getting the money. Okay, you got to close by Friday. We got to get the money, and you get the money into an LLC. You then rotate that over. You then go flip the house. You do the paint, appliances, carpet. All you guys know all those strategy. Pull it together. You then sell the house. You pay everyone back, and then you start over. How'd I do? Is that pretty good?
Yep, that's pretty good.
And then you start again, right? And then you find a new property, and you're calling up people. Okay, we got to get money in. We got, you have this whole closing period. This is what this one guy was doing, which is fine. It's actually a good way to build a tracker. It's a great way to go. But he said, can I do a fund? I said, yes, let's do a fund. So we set up what you do with a fund. We raise capital once. We set up all the entity structure once. And then he was able to use that one group of capital and one group of structure to go flip 72 homes in 1 year. Like people that are house flippers, do you guys think you'd win more deals or less deals if you had a fund and you could show up to a closing and say, hey, I've got proof of funds. They are right here. I can close tomorrow. Right? Probably a few more deals than less deals, right? Do you think you'd get better rates from banks? Probably, right? With a fund, you have bank relationships, you can get lower cost of capital. All of a sudden, you're now beating out your competitors because there's a bunch of people bidding on homes. And I went and bid on a duplex last year. We had 38 cash offers.
Wow.
38. 38 full asking, and we had like 16 full cash offers on that as well, which is crazy, right? With a fund though, you get better rates, you can outcompete your competitors, and also you have economies of scale. This guy that does 72 homes, he has crews now that just move from house to house. He has a whole tile crew and a carpet crew that just move, and he gets better rates because it's like a bulk discount, right? So all of a sudden, capitalism 101 is all excess margin will be competed away. You can compete away your competitors because you have more margin, right? Interesting, right? So that's a huge benefit of funds. The second thing I'll say about the benefit of funds, my dad's funds, that he mentioned this kind of story. He goes, we often win deals over syndicators, even when we're a lower cost. So for example, we'll bid on $100 million apartment complex. Mm-hmm. And by the way, with funds, you can start getting out, because everybody that has a dog and a grandma can get a couple $100,000 together to buy a single family house. Very few people can get money together to buy a 30, 40, 50, $100 million apartment complex. Your number of bidders goes way down. So he said, for example, we were bidding on a $100 million apartment complex. We came in and somebody else, a syndicator, came in at $100 million. And they were going to take 90 days to get the money together, and they were going to syndicate. We came in at 96 million and we won the deal. Why? Because winning a deal isn't just money, it's terms. How quickly can you close? What's your ability to close? What's your bank rate? Like all these things. They said, hey, we can close in 21 days pending all these approvals and stuff. And they won for a $4 million discount.
Wow.
Okay. That's the power of funds. So is that helpful in that first segment?
Yeah, totally.
This is why most people that are successful in business and real estate end up running a fund one day. And the other thing too, sorry, I'm just going on and on. If you guys are okay with that, the accounting. You guys as syndicators, you got individual deals. You got to remember, okay, that investor's on this deal and then this deal. You have all these different deals. It's so fresh at the end of the year trying to do taxes and stuff. You pull it all into one group. It's one set of all properties. Now, when pitching investors, right? If you have investors that love syndications, don't want to move to funds. Again, now I'm not saying syndications are bad. I'm just saying if you want to scale, most people do funds. And I'll share a quick example, actually. So Jordan's on here. Jordan and my dad were original business partners way back when. Jordan Hutchinson, if you see Jordan, if he's in your group, you guys can say hi to him. They were doing hard money loans way back when. I think they had they would syndicate hard money loans together. And so they needed, I remember he told me a story. It was like they were doing like a $6 million loan and they were syndicating. So they're calling everybody up. Okay, we got to get money in by Friday. And money was going hard and all this stuff. And they had one investor that didn't wire in like the last $200,000. And they missed a deal and it hurt their reputation. They lost money on it. The guy couldn't close, all this stuff. And it really hurt their reputation in the area. And at that point, they said, never again. We will never again syndicate. And what they told investors was a couple of things. There's kind of pros and cons of the fund. We're going to move to a fund model. You're going to put money in. We're going to do capital calls, all that kind of stuff. Number one, if you're doing real estate, you are now diversified across a portfolio of properties. Let's say we're going to do 100 house flips. Yeah, 5 are going to make a ton of money. 5 are going to lose money. And 90 are going to be in the middle, and we're going to produce an average return just in case there's a fire on one of them or a flood. You're diversified across a whole portfolio. Number 2, you're protected from other investors. In a syndication, a lot of you may know this. In a syndication, investors can come in, they can kind of elbow you around. If an investor says, hey, I've got a tax problem, can you sell the properties early? Because I got to pay taxes. In a syndication, you're like, well, maybe, like, it depends on, and by the way, there's 1,000 ways to set up a syndication, but in some of the times you're like, well, shoot, like I got to sell or get this guy out. In a fund, your largest investor could call you up. They've given you $100 million. Bridger, you need to sell the properties because I have a tax problem. In a fund, you say, sorry, I don't serve individual investors. I do what's best for the fund. The properties aren't ready to sell yet. We're still seasoning them. And tough, this is what you kind of signed up for. And that's good, by the way, for other investors. Other investors that don't have a tax problem, you don't want them to get jerked around by some investor that maybe didn't manage their finances well. It protects you from lawsuits and it gives you more authority over the fund. If you guys remember The Big Short, you guys remember that movie, The Big Short?
Yep.
There's a great scene with Michael Burry. who's he played by? Christian Bale. He's kind of the autistic kind of guy. His investors come in and they're yelling at him. You got to get out of the positions, blah, blah, blah. You got to sell. You're an idiot. And he's just like, tough. You know, I believe this is going to happen. And ultimately he was right. Typically the average investor isn't good, right? They hire people like us to watch the markets, to make decisions, and to have, this is why, again, most people that are successful in finance end up in funds. It gives diversification to investors. It protects investors from each other, suing each other, protects you as the fund manager. It's an incredible system to scale. Back to that. So is that helpful, Tim, or people on the call? I don't know if I can keep answering questions, but
that was very helpful. Yeah. And as we go along here, if you guys have questions, feel free to type it into the chat. Okay. And I'll incorporate your questions in with my questions here. So let's let's switch topic a little bit, talk about how you attract the passive investors. What is your top way that you like a lot to attract passive investors into your fund?
Yeah, it's a good question. And it's funny enough, I work with a lot of fund managers, people that raise capital all the time. And I'll tell you this, there are 1,000 ways to raise money. And it's so funny what people end up doing. And they don't, like, we have a guy in our group, he only raises money from dentists. That's like it. And he's in like a dental group on Facebook. He pitches like 1,000 dentists at once on a Zoom call. It's incredible. And he's like, Bridger, he just found this thread, and that's like what he goes after. I have another guy, he only goes after like salespeople, like high earning salespeople. It's really funny. And it's not because they chose that. It's just by the nature of where their strengths lied, I guess. And so I kind of think of capital raising in 3 different categories. Number 1 is like, how do I get in the vicinity of people that have money? Number 2, once I'm in the room, how do I get in the room? Number 2, how do I convert in the room? Maybe I can show up to the networking event, but how do I actually convert somebody into someone that's wanting to hear a pitch from me or sees me as a fund manager? And then number 3, how do I actually close them? Like if I'm on the investor call, maybe I'm really good at getting in the room. Maybe I'm really good at like getting people warmed up to me, but then they get in the call and can I close them and actually get money in the fund, right? So kind of 3 different tiers of capital raising. We can talk about all of them, but I'll go back to the beginning one of like my best way to like get in the room or get with people. I think about it in 2 different ways. Work your way in versus buy your way in. So I'll kind of say 2 different categories. Number 1, work your way in. This is, a lot of us do this. You're on LinkedIn. You're kind of working your contacts. You're trying to get in to meet with people, right? You're working your way in. I think throwing events, by the way, is one of the best ways to get people in front of you. If you guys think back to like middle school, when you were 13 years old and you got invited to a party on the weekends, right? What do you remember about that party? Like not before, but hopefully you weren't like drunk or wasted or something. But what do you remember, right? Is you remember who threw the party. Oh, we're going to Chafin's party this Friday. It's at Chafin's house, right? You always, and then, or even if you show up, like, whose house is this? Like, where are we at? You always know the event thrower. And so this is actually something I learned from Jordan's dad, Jordan Hutchinson. Again, to highlight him, he's an incredible capital raiser. Guys, he's actually in our program and course. He does some videos and stuff. Incredible. He was so good at throwing parties and events. They did supercar parties and suits and all these cool parties. And what they do is show up at the house and like, who's through? Oh, it's Paul, or it's Bridger who threw this event, whoever it is. And they remember you. So I think that's a great way to work your way in events. If you look at my Instagram last year, I threw 4 events called Cars and Coin. So we have anybody that has a supercar is invited to come. So you have a supercar, you can show up to this cool mansion. We like have food there. We hang out, we talk coin. We talk about like markets and equity and what's going on right now. It's pretty interesting. Awesome event, raised us a ton of money. You guys can copy that event in your area if you want and invite me. I'd love to come out. We do it in Utah, in Salt Lake City. And people now are like begging us, when's the next one? Like, I want to come, like, I want to show off my cool car. Because people that buy cool cars want to show them off, so you give them a place to show them off. And then people that have nice cars usually have a little bit of money they want to invest. The other thing is work your way in. So that's work your way in and then buy your way in. I am an active spender into networking groups, pay to play networking, all that kind of stuff. So for example, like you could buy a Ferrari or a Porsche GT3 RS or whatever, and you can join in your city. There's probably a Ferrari club of San Antonio or a Ferrari club of New York or whatever. And you have to have a Ferrari to join that. That's buying your way in. And all of a sudden, everyone else there has Ferraris. You can meet all those people. I've joined networking groups. They were $20,000, $30,000 at a time. and everyone else there has also paid $30,000 to be there. And so you get put into a room of a ton of great people. I'm not even kidding. We totaled the amount. I have spent $265,000 in masterminds and networking groups in the last 3 years, or courses. Like, I'm a total product of events. I love going to events, mastermind groups, networking events. Like, I spend the money, I go, and because it accumulates the people you want to meet into one location, it's a lot easier. I buy my way in. So I do a mix. I work my way in and I buy my way in. If I'm talking about getting in the room, getting around the people, that gives you a few ideas, I guess. Is that helpful?
Yeah, super helpful. And yeah, hosting events is my favorite ways as well. Like this Zoom call that we're doing right now, we've been doing this July of 2022. We have had over 1,700 people that register to be on these calls, and every week, we have a capture audience. Like right now, we have 77 people on, and so yeah,
and everyone knows who Tim is. Oh, who's Tim? Oh, I know, it's the guy that throws the events. Like, you're the event thrower. I think it's freaking awesome, right? Like, everyone's like, oh, who's Tim? He already has authority now because he's the one who put together this event. And I'm more likely to invest with Tim than I am to invest with some random Joe Schmo, because Tim's given me a ton of value in my life. I think it's so cool. Yeah. One last example I'll give you is actually with Jordan's dad and my dad. So they did this thing. They bought box seats, season tickets to the Utah Jazz, 4 tickets. And my dad was freaking out. I was like, I don't know how much money. It was like $40,000. He's like, we don't have the money. We can't spend it. Like, what are you talking about? We're a startup. Like, how can you do this? And he was like, Jordan's dad was like, oh no, like, we're going to be fine. Like, we're going to be good, because oftentimes it's hard to get past the gatekeeper, right? You're trying to call CEOs, people, you're trying to get past the gatekeeper, and there's assistants. They're like, no, they're busy, whatever. So he goes, what we're going to do now, and this is what worked for them. They raised a ton of money doing this, is they would call an assistant and say, hi, is Mrs. Johnson there? No, she's busy. She's in a meeting. Okay, I just want to leave a message. We have 2 tickets for Mrs. Johnson and her husband tonight. The Utah Jazz are playing the Lakers. They're box seats. We have a dinner beforehand. We'd love to invite her tonight to the game. Often enough, that assistant's going to pass that message along. And then all of a sudden, Mrs. Johnson and her husband show up to the game, and you got 4 hours with them. Wow. You got a dinner, you get to sit by them, you get to talk, you're talking business, all this kind of stuff. And lo and behold, you'll probably end up talking about your fund or your investments. And they were like, that raised us. That was the best $40,000 they had ever spent in their entire lives, was that, because they met every successful, good person in the area with that. It was a pretty interesting tactic to try to give you guys some nuggets to take home. Like, that's a pretty cool one.
That is a pretty cool one. Yeah, that's a baller one, and it's cool. Yeah. Awesome. Yeah, and then so you mentioned about different people have affinity towards certain groups, and so find the groups that you resonate with, right? That plays well to your strengths, whether that's dentists or entrepreneurs or whatever the group that is. How do you like, for yourself, Bridger, do you specifically try to target groups that are high net worth individuals? Do you work, like, try to find accredited investors as much as possible, or do you play a wider reach, like with your social media? I know you're pretty big on social media, so you play a wider reach, and whether they're accredited investors or not, you want them all in. Which one do you go after?
I mean, it's hard to know, by the way, who's a high, like, some people, they're just regular Joes. You just don't know, right? And so you just don't know how much money people have. So I treat everyone like they're, a billionaire, right? That's what I try to do. So we do some of our events to try to target more accredited people. My stuff on social media, though, we put it out to a lot of, like, a big audience. We kind of do both. So on the Cars and Coin events, it's like, hey, if you have a supercar, you're invited, or if you're a friend, kind of invite only. And we try to say, like, invite, like, your accredited baller friends over. So it's kind of pulls more of a wealthy crowd, because people that are wealthy want to hang out with other wealthy people. The other stuff I do, like, on social media, we have a live event we're doing, like 2,500 people coming. Like, that's just public, right? Because you never know. And we put out a lot of content on social media of just funds. You just never know who's, maybe don't have money, but their uncle might have money, or their grandpa, you know what I mean? And there's a lot of indirect connections that we make through that with social media. And then anyways, across the board. So we do both.
Gotcha. Okay. And then, so in terms of, credibility as a brand new fund manager, let's say, you never had a fund before. Should you start out with a smaller fund so that way you have a track record of running funds, or at what level would you say, okay, yeah, you can start out with a $50 million fund? Or I have a friend, his first fund, $100 million fund. I'm like, what? Right. Yeah. So what are your thoughts on that? Starting out small as a small fund, build your track record as a fund manager before doing big one, or if you have the confidence to go for a big one, you go for it. What's your thought?
Yeah, I see both, and I see people successful with both. So what I tell people too that are syndicators. Syndication is a great way to build a track record. I've met a few guys that they've syndicated for 10 years and they feel like they don't have the credibility yet to run a fund. I think I don't, again, it's up to your comfort level, but you don't need to syndicate for 10 years to move into a fund. I think you can syndicate if you do even 1 or 2 deals syndication. I've seen guys just do that and then move into a fund model. And then they can do a small fund or a big fund. It comes back to their credibility. I would say the bigger way with a fund, at least, you want to do a fund big enough to do at least, in my opinion, at least minimum 5 deals. You shouldn't do a fund for 2 deals. It just not worth it. Like, just syndicate 2 deals, in my opinion. Have 5 deals. There's at least 5 that's diversified. So if your average deal size is 25 million, then 5 deals would be $125 million fund AUM, but you're going to probably leverage. So maybe you're raising $50 million equity, $40 million equity, and then you're going to raise and have $125 million AUM. I would just make sure you had 5 deals done in there. Maybe you're just a house flipper though, and to do 5 deals, you need $3 million, and that's totally okay too. We have people that do that as well. But there is a thing with funds, to your point though, of playing the fund game is I would play the long-term game. It's why you do funds. Don't, funds are not meant to be like turn and burn, just screw people. Like I personally, I'm playing the long game. I don't want to be rich. I want to be really rich. And I'm willing to play the long game of funds, because funds have produced some of the wealthiest people on planet Earth have come from funds. I see somebody with a yacht background if you look at fund managers, they are the top earning people on planet Earth, people that run funds. It's unreal. Like the top fund managers all last year are making 100 to 250 million a month.
Wow. From
one income source. That's not personal properties. That's not investments. That's not net worth. That's not like Elon Musk's net worth goes up and then it goes down with Tesla stock. That is just cash returned to them from their fund, 100 to 250 million a month. Jim Simons, I think, did 3.5 billion last year from his fund from one income source. It's wild how much money you can make from funds. And so if you play the game right, if you treat investors right, if you are fair to them, they will compound and tell their friends, and they're going to add more money and more money and more money. It's going to get bigger. I tell people the hardest thing about funds is starting, right? Is getting started. It's launching. If you can get launched and get moving and then treat your investors right, get good returns. It can compound very quickly and you can do very well.
That's awesome. All right. So William Holland has a question here. To do a fund, does a fund manager have to be registered with the SEC?
Yeah, great question. It depends is the answer. And I'll tell you what it depends upon. So I'll tell you, for my 3 funds that I'm on, I have never held a license. I've studied for the Series 65. I thought I needed it, and my lawyers told me I didn't need it. Okay. Now, the one license you may need for any fund is a Series 65. Okay. Now, people get crazy. Series 7, Series 8, like you actually, well, depends on your fund type again, but you don't usually need those. How it works, if we can get a little technical here, if that's okay with you guys. The SEC versus state level, if you are under $150 million AUM, you fall under the state's level. If you're over 150 million, you fall under the SEC. You are not in both. You are one or the other. And so most of us will start funds probably under 150 million. So it comes down to your state that your primary business operations are in. So I'm in Utah. Okay. in my state, at least my lawyers have told me, to run a crypto fund in my state, I do not need to be a Series 65 license. I can file an exempt reporting advisor, what it's called, and we can still charge management fees and performance fees, all that kind of stuff. Now, once I hit 150 million though, then I've got to register with the SEC, and usually in the SEC, they want you to have a Series 65 license. It also is determined upon what type of fund you run. So for example, I'll kind of say from top to bottom, the venture capital is the least regulated. They have great lobbyists, lawmakers love venture capital because venture capital like invests in startup businesses. You like rarely need a license in venture capital. Anybody can open a venture capital fund and charge fees and stuff. And again, not legal advice, but rarely needs licenses. The next tier actually is real estate. So I know a lot of people here in real estate is not a security. And again, if you go back to the Howey test and how you define a security, a lot of times it's not a security. You can file for the 3C5 exemption. So what it's called 3C5. Under your fund, you have to hold 80% of your portfolio has to be real estate. And if you do that, a lot of us, again, check on your state, but almost always you do not need a license to run that. You can run a large real estate fund without doing that. Even over 150 million, sometimes you get a special case. And it's usually good practice though, once you hit off 150 million to get the Series 65. The next tier would be private equity. Some states are good with private equity, some states aren't. The last one is hedge funds. Hedge funds are typically more scrutinized than anybody else, depending on what you're buying. If you're doing futures or whatever you're buying, it just depends. And so with a hedge fund as well, you can sometimes use a prime broker. That's who executes your trades, and they hold the Series 7, they hold the Series 33 to do leverage and all that kind of stuff. Use prime brokers to do that. But again, I run a hedge fund. It's in crypto, and our lawyers came back to us and said, "Hey, you guys do not need licenses for that," which is pretty cool. So again, not legal advice. Go look it up yourself, but that's kind of gives you a framework of how to think about it. But venture capital, easiest. Real estate's next. Private equity, and then hedge funds on the way down as far as licensing goes and what you need to have. So it's actually pretty cool.
Yeah, that's good. Thank you for explaining that. So another person asked, for the investors, do they have to be accredited, or can they be just a 506B as well for a fund, I guess?
Yeah, good question. It depends. So back to it depends, right? I won't go through everything, but some funds require you to have accredited investors. Some funds, actually, it's above accredited. You have qualified clients or qualified purchasers. Did you guys know there's 2 tiers above accredited investor? So a lot of us heard like accredited investor, right? There's actually 2 tiers above. Accredited investor, what that means by the SEC's definition, you have $1 million net worth, excluding your home. You make $200,000 a year or $300,000 a year with a spouse. And they've just recently allowed, if you can take a test or other stuff, and you can qualify as an accredited investor. That's an accredited investor. In just general rule, most funds, you got to be an accredited investor minimum to join. Now there's 2 tiers higher. The next tier is a qualified client. Qualified client has a $2.2 million net worth, excluding their home. Next tier up is a qualified purchaser, $5 million net worth, excluding their home, or an entity with $25 million of assets. Okay. You'll hear people on CNBC, and they'll say, "Hey, our fund only takes qualified investors." And you think that means accredited investor. It does not. It means a qualified client or qualified purchaser per fund types. Now there's the low tier is just called a non-accredited investor. That means you just don't fit any of the categories. So I won't dive into all this. It'll take too long. We have other videos and stuff you guys can go watch, but different funds allow you to do different things. There are some non-accredited funds, crowdfunding, Regulation A, similar to what Grant Cardone does. That's for non-accredited investors. In my opinion, a lot of overhead. You need to spend a lot of money to do that, though. It's like running a public company because you're issuing things to regular people. In my opinion, what most funds do is they raise from at least accredited investors or above through usually a 506B, 3C1, 3C7, if you know what those mean. But anyways, most funds are accredited. Not to talk too long, but most funds it's accredited or above. The way that, just to help you remember this, the way the SEC looks at it is if you take money from somebody who's rich and you lose it, well, yeah, that was tough, but it's not that big of a deal. It's still a big deal, but it's not as big of a deal. If you took money from grandma, let's say grandma's got $20,000 to her name, and you come in, slick talking fund manager, you take grandma's money and you lose it. And now grandma can't live anymore. The SEC really hates that. And they are going to come after you like crazy. And so that's why they scrutinize non-accredited investors way more. So it's way harder. You got to publish like a public company. You have to have reports and all this crazy stuff. If you're raising money from multimillionaires, they should understand the risks of investing. Is kind of how the SEC, at least in my opinion, how the SEC thinks about it. And so you're less scrutinized the higher tier you go. So if that's helpful a little bit.
Yeah.
A lot of these funds will be pretty, they'll be pretty, I know, meticulous with the number because you're limited in number. So for example, you guys know Ray Dalio.
Yep.
You know, Ray Dalio on here. He's written a bunch of books, all that kind of stuff. So Ray Dalio's funds stopped raising money in 2005. His minimum investment was $100 million. You had to have a $4 billion net worth to even talk to them.
Wow.
Crazy. And he stopped raising capital in 2005. That's how much money he had thrown at him. There's one rule where you're capped at 1,999 investors. So he said, I'm going to just max out each one of those. And we're going to get as much money as we can for each individual investor spot. And so literally $100 million minimum commitment. They manage what, 240 billion right now. It's just crazy how much they manage. And that's the reason for that. Like a lot of these funds on Wall Street, you can't even invest into because they're so limited. Like Jim Simons hasn't raised money since 2008. One of the most profitable, successful funds of all time. You can't even get access to. It's pretty interesting. So sorry, I digress. There you go, Tim.
Awesome. I love it.
Is this helpful? Hopefully this is helpful kind of.
Yeah, it's very helpful for sure. What are some of your favorite tools to help you as a fund manager?
Favorite tools?
Yeah. Software tools or even resources.
Yeah, I recommend everyone to use a third-party administrator for their funds. So we use NAV Consulting. They're great. They help finalize all your reports, all your documents, make sure it's done correctly. Personally, though, I love, just selfishly, I love hanging out with other fund managers. We have this group of fund managers. Some of you guys are in it, called Black Card and other groups. I love hearing from other funds, what they're doing, what they're watching, what are they investing to? Why are they investing in that? I learn so much from other people that run funds. It's really cool. And like, I think that's the best resource. And then I hear something we can talk about. Like I just saw Chafin putting like the petrodollar and like how that's OPEC's changing stuff. Like I love studying that, and maybe somebody else loves studying something else, and we'll share like, okay, this is what OPEC's doing. This is what like the CHIPS Act's going on. This is how they just banned all semiconductors to China. Like, what does that mean for the investment world? Like macroeconomics. I just love it. I think it's so fun because it kind of shows how the world's working, where money moves. So it's kind of sounds cliche, but a network of fund managers is a pretty cool tool. Yeah.
Yeah, that's good. Well, I know you have your fund launch event coming up in May, right? And you're expecting how many people? I know it's going to be pretty big.
Yeah, the one in May is 2,500 people, which is just wild. So last year, this event behind me, this was Fund Launch Live #1. We sold out about a month before. We had 1,200 people live, which was so cool. It was crazy. I think you were there, Tim, right?
Yep.
Were you there?
Yep, I was. That's how I got into this whole business. Yep.
Yeah. That's how we met. So you were there. And then, so this year we're doubling it. We've got Ed Milet coming. We've got Jim Rogers, who's the co-founder of the Soros funds way back when. And one of the most famous funds of all time, the Quantum Fund. He's coming to speak. We have multiple fund managers that manage billion-dollar funds coming to speak. And so it's meant for people trying to raise capital, people trying to launch funds. We go very in depth for 3 days on Fund Launch in Fund Launch Live. So if you guys want to learn more, it's just fundlaunchlive.com or just fundlaunch.com. You can go see all of the videos and cool stuff, and tickets are on sale. I think actually tickets are jumping in price this Friday. So we jump prices because we're selling out. We're actually ahead of schedule for selling this event out, which is pretty cool. So we jump prices. All we do is that's how we price our tickets. We just start them low and we just slowly price them until the event. So we are doing another a major price jump on Friday. So just so you guys are aware, if you want to come. But people came. That's cool. Yeah, it was fun last year.
Yeah, it's good. So fundlaunchlive.com, right? Okay.
Yep.
Yeah. So I guess we'll lead right into that. The folks want to reach out, to you, connect with you, invest with you, partner with you. Where would you like to send them?
So we have a bunch of stuff. If you guys want to learn more, I geek out on funds, if you can't tell. So we're eat, sleep, and drink this stuff. So we have a free course on funds, 100% free. It's my gift to just it's 40 events to just help people learn about, 40 videos. I said event, 40 videos on how funds work and are put together. So if you go to fundlaunch.com, that's there. It's 100% free. And my goal is that I'm just going to knock your socks off. And then one day when you want to launch a fund, we have lawyers, we have like people that come design your pitch decks. We have live events. You can join stuff and you'll call me up. Be like, yo, Bridger, I need to launch a fund. Like, let's work with you. I believe in giving value up front and just paying it forward. So we have that. We have a free Facebook group. We've got the free course. We've got, a bunch of free videos on YouTube. Just we try to get a ton of free content. And then also, yes, we have paid courses and paid groups and other stuff. We have fun events that we do. And it's pretty fun. So there we go.
There's a question. Anthony said, did Fund Launch book Ray Dalio for the Miami event?
Not yet, Anthony. We have we've talked to Ray's assistant, I think 6 times. She keeps telling us no. And we're like, hey, does Ray want to come? We are trying to book him for next year's event right now. I think that he was out of town or busy for May, but we're trying to get him for Fund Launch Live 3, which will be next year. So we'll see if we can get Ray Dalio. If anybody knows Ray Dalio, we've put a standing order, $20,000. If anybody gets us Ray Dalio or introduces us and helps us close Ray Dalio to come to the event, we'll pay you $20,000. So there you go.
That's good. All right, Richard, thank you so much, buddy, for doing this. Yeah, thank you so much for doing this interview with me today and joining us today. Really appreciate you greatly. And yeah, look forward to attending, seeing you in Salt Lake next week and then see you in Miami as well.
Well, Tim, thank you so much. Fantastic group. You guys are amazing people. Fun to hang out. Good questions as well. This has been fun. So if you guys want to ask me questions too, send me just a message on Instagram. So Bridger_Pennington, just send me a message there. We can chat or hang out, whatever. Look out for the scammers. There's a ton of scammer accounts. So find my accounts, Bridger_Pennington. But Tim, thank you so much. You guys are awesome.